Hello and welcome back to the channel. Thank you very much for stopping by. Today we're talking about grid systems and more specifically the importance and the impact of changing the volume exponent, or also called the multiplier settings in your grid trading. How does it alter performance and how does it change behavior? We're going to talk about that today. In the sample today, we're on the CTrader platform, but all the information is also valid for MT4, MT5, or any other platform that you may use. We're on the euro pound on a 30-minute chart, but again, the information is generic and it can be applied on any instrument and any time frame. So what is the multiplier and what does it do? The multiplier essentially changes the amount of retracement that you need in order to exit with profit in your grid system. Prices go up, we open sell trade, and once the prices retrace, we're going to exit with profit. And what we're going to do here is we're going to set it up to run, and then we're going to observe what's happening here. I just configured the multiplier here to 1. And what you will notice is that we have the initial lot size of 5K. And that doesn't change at all. In fact, all the trades that we're opening are 5K, whether it be buy or sell trade here. It doesn't matter currently. By the way, if you are wondering why the take profit levels are changing, it's because we've enabled the adaptive mode on this particular algo. It means that it analyzes volatility. So when markets move a lot, we increase the distance between trades. If you're interested in that approach and want to learn more about that, you can click on the link below the video. We'll take you to a page that will explain much more about that approach. Pros and cons of using a very low multiplier. 1 is essentially the lowest you can go when we talk about multiplication. And what it means is simply we're going to add to our position sizes as prices move, but we're only going to add the next trade with the same amount of our initial position size. That generally means that you're less exposed in the marketplace. But it also requires prices to retrace a lot in order for you to exit with profit. You can see here we have a lot of sell trades being open here. And we had maybe a news release here. You can see from that candle here. And you can see that we really need prices now to drop and drop with a significant amount. Otherwise, we will not exit with profit. Let's see if that happens by following the market moves here. You can see there's a support level here being tested. Let's see if it breaks through. It did indeed. And there all the positions were closed, but we did need a fair amount of a move in the marketplace in order for that to happen. So low settings such as 1, who's that a fit for? More conservative traders, traders that perhaps have a smaller account size, and perhaps also less leverage, because as you're not multiplying, as you're not adding increasingly more and more to your position sizes, this might be appropriate for you. But keep in mind that the choice of instrument is also incredibly important. Now, if you don't have, if you haven't chosen the correct instrument, if you're choosing like instruments that trend a lot, this will absolutely not work. So you need instruments, asset classes that have historical data that shows that historically it ranges a lot. So that's an important consideration. When you're going to stop this one, keep this behavior and performance in mind. We're now going to bump up the volume exponent just to see what happens in the trading behavior. So what we expect now is that as prices go up, for example, we expect the initial investment or position size of 5K. We expect the first one to be multiplied with 1.5 on the second trade, then again 1.5, then again 1.5. And our expectation is that we need less retracement now to exit with profit. And let's see how that plays out by running the backtest again. All right, so off we go, and let's see. And we can see that happened here. In fact, the second sell trade was 7K. And indeed, very little retracement was enough for the algo to reset. This particular algo, it closes all positions when a certain profit target is met, and then the trading logic restarts. Let's continue to see how it performs here. We're waiting for a major market move, and there it happens. So second trade 7K, third trade was open here as well. And what you will note is that we need very little retracement now, or less than we needed before. We're still waiting for enough retracement to close all trades with profit. And that happened there, as you can see from the equity curve, and then the trading logic restarts. Okay, so lesson learned. So what happened here? As we increase the multiplier on the grid setting, the requirement for retracement is now lower. We need less retracement to exit with profit. So that what that looks like. All right, so what we're going to do now is going to bump it up again. A lot of grid systems, they come with 2 as the factory setting, so that's easy math right there. So if the initial position size is 5K, on the second trade we open 10, then 20, then 40, then 80, and 160, and so on and so forth. Now the impact of that, of course, is that we need much less retracement again, but it also means that our exposure in the marketplace is higher, and the requirement to leverage is higher. Once again, let's do the same run and then see how that plays out. All right, so off we go, and the second trade was indeed 10K. And we can now see that we exit that trade even faster than we did before. So once again, different from those who are coming from perhaps a trend trading background. When you trade the trend, you ride the trend, you scale in the direction of the trend, and as soon as the trend is over, we exit, take the profit, and we avoid trading in markets that move sideways. When we are using a grid system, it's actually pretty much the opposite logic. We want to make our money when markets move sideways. We want to be careful when markets trend and find reasonable exit points. So here you can see the performance. The multiplier is now 2. We experimented with 1 and 1.5, and now with 2. And what we're clearly seeing is that we have closed the total number of positions in this algo. We do that faster the higher the multiplication is, because we add a substantial amount to the initial size, and that also means that we're able to exit trades faster. It also means we're more exposed. You can see here we have now more drawdown temporarily. We need less retracement to exit, but there we have it. So we were out of the trade faster, but it also implies a larger drawdown. So as a rule of thumb, as we increase the multiplier, we add more to the positions. We need less retracement to exit with profit, but on certain circumstances, the total drawdown on the account will be higher. This is not recommended in any way or form, but I'm going to set this to 3. A multiplier of 3 means that if the initial lot size is 5, the second trade is now 15, right? And then it's 45, so it will increase very, very fast. Let's compare the drawdown levels. So when you decide on the multiplier, you really need to factor in a number of things. What is your risk profile? What is your account size? And what is the general behavior of the instrument you're using? Myself, and that's a personal preference, after having used grid systems for many years, I don't use a multiplier larger than 2.5, but it's a personal preference. You can, on certain instruments, configure algos correctly to also work well with 3. But as some people have learned the hard way, if something, you see just how little retracement we need. Have a look at that. So now we're closing positions fast, as you can see on the video there. Under very big and significant global events, a multiplier of 3, if there's a big market move, that might not be what you want to do. So yeah, again, depending on the instrument you're trading and your preference, you can see here, multiplier of 3, we are closing positions super fast. We need very little retracement in order to exit and close all our positions in profit. Okay, so there it is. So the conclusion, what does the multiplier do? The multiplier essentially determines the level of retracement needed to close all positions in profit with your grid system, if it's a profit averaging system like this one. And so the lower the setting, the more positions I'm going to carry around, but the less exposure and the less risk it is, certainly short term. The higher the multiplier, the less retracement I need to exit with profit, but the more exposed I'm likely to be in the marketplace. If you found this video interesting, please make sure to subscribe, give a like, and don't forget to visit the page. You can see this algo trade as well. The link is in the description below. Thank you very much for stopping by, and see you in the next one. Bye-bye.